Welcome to the Deep Dive. We're the show that cuts through all the noise and gets you straight to the insights you really need. Let's be honest, today, finances, honey,
Mm,
it can feel pretty overwhelming, right? It may be a
mhm.
bit uncertain. We get all this financial news thrown at us, but sometimes it feels like you're just, treading water, not really sure how to build that secure future. So today, we're going to dive deep into the fundamentals of personal finance. We're using a really powerful source called Saving Your Future. It kind of lays out a clear path.
Yeah, and our mission here really is to just boil down these crucial financial ideas into things you can actually use. Clear, actionable stuff. We want to give you a shortcut, basically. Help you get properly informed without feeling like you're drowning in data. And you can expect some, well, surprising facts, but also really practical advice you can start using right away to change things up.
Okay, let's unpack this then. The book paints a pretty stark picture of where North Americans are, financially speaking. Just listen to these numbers. Think about how they maybe connect with what you see around you. In Canada, a staggering 35% of people, no savings or investments, none. And only 27% in the private sector have an employer-funded pension. The average RRSP savings, just $55,000. It feels like those old safety nets are, well, they're fraying, aren't they?
It's fascinating. You see similar things in the US data. It's consistent. You've got 33%, that's what, over 77 million Americans not paying bills on time, 39% carrying credit card debt month after month. Only 59% of adults even say they have savings. And maybe the most shocking, more than half now think it's okay to default on a mortgage if things get tough. These aren't just numbers, they show real vulnerability.
You can really feel the weight of that.
Yeah.
And the source connects this to what it calls the new world. The start of the millennium brought a lot of turbulence. Y2K fears, the dot-com crash, 9/11, the 2008 crisis. How did that whole era impact the different generations, boomers, Gen X, millennials? How did it set us up for this?
Well, that turbulence is exactly what led to what the book calls the New Awakening. It's a big shift in thinking. The old idea, where you just kind of assumed your company or the union or the government would handle your retirement, that's dissolving. Those traditional pillars, your own savings, company pensions, government plans like Social Security or the Canada Pension Plan, they're all looking shaky now.
Hey, you're on this.
Back in 1945, for Social Security in the U.S., there were over 40 workers paying in for every retiree. Today, it's down to about 3 workers per retiree. That kind of ratio change, it changes everything for individuals, doesn't it?
Wow. That really brings us to the core idea in saving your future, doesn't it? This huge shift from Social Security to self-security. It's not just a suggestion, it's like a call to arms. You have to take charge of your own financial future, build new habits. You can't just wait for your employer or the government. The book argues it's your job now, and maybe your biggest chance too. Okay, so if we have to take charge, where do we even start? The source gives this great framework, 4 layers of a financial foundation, like building a house, right? Ground up, it goes. Protection, then debt management, emergency fund, and finally, investment. What's interesting is why protection is right there at the start, the absolute priority.
Exactly. Because you don't have that protection layer sorted, everything else you build could just vanish overnight. Imagine saving for years, right? Then boom, an illness, an accident, and if you weren't insured properly, those savings could be wiped out. Just like that. The source also gives us the wealth formula. It looks simple, but it's incredibly powerful. It's money plus time plus made of a return inflation tax, Colt's wealth. When you look at that equation, what part do you think people underestimate the most? And how can you really use it?
For me, looking at that, it's got to be time, definitely. And speaking of using these ideas, the book has practical money talk strategies. First up, that classic advice. Pay yourself first. It's not just saving leftovers. It's treating, say, 5 or 10%, maybe more, of your income like a bill you have to pay, your family financial bill. Pay it before anything else. Then there's buy only what you need. This is huge, really figuring out needs versus wants. Do you really need that fancy gadget? Or just want it? Is it a Lexus you need? Or would a reliable Toyota do the job just fine?
That shift, needs versus wants, connects directly to this other idea. Small changes, big money. If you just manage to save, say, $10 a day, maybe cutting out that fancy coffee or packing a lunch that's $300 a month. The book shows how saving that $300 monthly, if it earned 8% interest, could grow to over $447,000 in 30 years. It's a great reminder. It's not just about what you earn, it's about what you keep and how you make it grow.
And this next point is where it gets really powerful when we talk growth, time, that factor we mentioned. The book uses this amazing example. Mr. Start Early versus Mr. Wait Longer.
Yeah.
Picture this. Mr. Start Early saves $3,600 a year, but only for 7 years. Total contribution, $25,200. Then he stops saving completely. Mr. Wait Longer starts 7 years later, saves the same $3,600 a year, but does it for 17 years. Total contribution, $61,200. Way more money in. But here's the kicker. By age 48, Mr. Start Early, who put in way less money for less time, has almost as much $128,361 as Mr. Wait Longer, who has $131,221. It really shows you, doesn't it? Don't put it off.
That example perfectly tees up the next big concepts: rate of return and the magic of compound interest. Einstein supposedly called it the eighth wonder of the world. The rule of 72 is a neat little trick to get your head around it. Just divide 72 by your annual interest rate. That gives you roughly how many years it takes for your money to double. So say you have $10,000 at age 29. At 4% interest, it doubles roughly every 18 years. By age 65, it's maybe $40,000. But if you could get a 12% rate of return, that doubles every 6 years. That same $10,000, it explodes to $640,000 by age 65. Huge difference.
That difference is genuinely mind-bending. So the rule of 72, like the source says, it's almost like a quick check, isn't it? It kind of sorts people into two groups.
Yeah.
Those who don't really get how money works, so they spend their lives working for it, and those who do get it, and they figure out how to make their money work for them.
Precisely. And that understanding hinges on knowing the difference between simple interest versus compound interest. Simple interest just pays on the original amount. Like Mr. A puts $10,000 at 8% for 10 years, gets $18,000 total. Simple. But compound interest, that's where your interest starts earning its own interest. Mr. B, same $10,000 at 8% for 10 years, ends up with $21,589. Doesn't sound like a massive gap there, but stretch that out over decades. Compounding is immense. Which brings us to the real rate of return. This is critical. You have to factor in taxes and inflation. The book gives this example. You save $100, it earns 3% interest, but you pay 25% tax on the earnings, and inflation is running at 3.5%. Guess what? You actually lost buying power. You effectively need to earn at least 5% interest, maybe more, just to stay level after taxes and inflation bite.
That's a huge realization for a lot of people, I think, often overlooked. And speaking of things eating away at your money silently, let's talk inflation, the silent killer. Inflation isn't just prices going up a bit. It's relentlessly shrinking the value of your dollar. What buys a dollar's worth today might only buy 80 cents worth down the road. The source says $100 today could be worth just $55 in 20 years, assuming 3% average inflation. So think about it. If you need, say, $4,000 a month to live on today, in 20 years, you'll need over $7,200 a month just to buy the same stuff. That's vital for planning.
And this leads right into another certainty Ben Franklin talked about: taxes. He said death and taxes, right. The source points out you're taxed when you earn, when you spend, when you save, even when you die. And the challenges ahead look pretty big. We've got shrinking tax bases, growing government debts. Back in 2015, the U.S. debt was $18 trillion. That's like $56,500 for every citizen. Canada's was $692 billion, nearly $20,000 per person. With fewer workers supporting more retirees and rising costs, the source strongly suggests taxes are probably going to go up.
So knowing where your money is going and how it's taxed becomes really strategic. The book breaks down common accounts into 3 buckets: tax now, tax later, and tax advantaged. Tax now is like your basic checking or savings. You earn interest, you pay tax on it that year. Simple. Tax later. These are popular ones like 401ks in the US, RSPs in Canada. Your contributions might be pre-tax, the money grows tax deferred, but you pay income tax when you take it out in retirement.
Right. And then you have tax advantage. Think Roth IRAs in the U.S. or TFSAs in Canada. Here, you put in money you've already paid tax on, but the magic is when you take qualified withdrawals later, totally tax-free. The book uses this before or after example. Mrs. A chooses tax later, Mrs. B goes tax advantaged. Both invest $10 at 8% for 36 years. If tax rates stay the same at 25%, they end up roughly equal. But what if rates drop to 15% in the future? Mrs. A, tax later, comes out ahead. What if rates jump to 35%? Now Mrs. B, tax advantaged, wins big time. It shows the gamble you take on future tax rates, choosing whether to tax the seed now or the harvest later.
Let's shift gears a bit. There's this concept in the book called the X-curve. It's a really neat visual for how your financial life ideally plays out. It basically shows this inverse relationship. Over your lifetime, your responsibilities, things like debt, mortgage, kids needing support, should gradually decrease.
Exactly. And as those responsibilities go down, your wealth, your savings and investments should be going up. So the lines cross, making that X shape. And what this implies, according to the source, is that as your wealth builds, your need for protection, especially life insurance, actually shrinks. Like if you figure out you need $500,000 of protection today, but you manage to save up $100,000, well, your actual insurance need drops to $400,000. It also connects to why paying down your mortgage faster is so powerful. You reduce that big liability sooner, freeing up cash flow.
The book calls this the X curve for the responsible. It really hammers home that you need discipline, consistency, clear priorities to make this work for you. It also frames insurance or investment, not as an either, but like two sides of the same coin, both working towards financial independence.
And a massive part of getting there, one that often trips people up, is debt management. You got to get a handle on debt. The source uses this brutal credit card example. You owe $5,000 at 18% interest. You pay $200 a month. Seems reasonable, right? It takes you over 11 years to pay it off. And you pay thousands just in interest. It's destructive. But then it shows the flip side. The power of mortgage prepayment. An extra $500 a month on a $300 30-year mortgage at 4.5%. That could shave off almost 12 years of payments, save you tens of thousands in interest. So the strategies are clear. Stop taking on new debt. Use cash more. Spend only on necessities. Pay off smaller debts first for momentum.
Okay, so we built the foundation, tackled debt. Now let's look at the tools for growth, the investment side. We should probably start with a quick look at the capital markets. Not getting lost in jargon, but just understanding the main playing field, stocks, bonds, market indexes like the Dow, the S&P 500, the NASDAQ. Knowing these basics is key for any long-term plan.
Yep. And besides the capital markets, there's the money market too that's for shorter term, generally lower risk stuff. And if you look at the history, the performance of stocks, bonds, and T-bills going way back, like 1926 to 2013, the source shows large company stocks have, on average, beaten government bonds and treasury bills over the long haul. Now, that's history, not a crystal ball, right? Past performance doesn't guarantee future results, but it gives you important context for thinking long term.
That's a really important disclaimer. Always. Okay, so the source gets into mutual funds. Most of us have heard of these. They're popular because they pool money from lots of people. You get professional managers and instant diversification. There are different types: money market funds, bond funds, stock funds, balance funds. And yeah, you should know the NAV, the net asset value, but the book really stresses understanding fees and expenses. Those sales charges or loads and the annual operating costs, if you don't pay attention to those in the prospectus or fund facts, they can just nibble away at your returns year after year. It really adds up.
The advantages of mutual funds are pretty clear, like you said. Professional oversight, diversification, they're usually easy to buy and sell, and you can often start with a fairly small amount. But the disadvantages are real too. There are no guarantees you'll make money or even get your principal back. And those fees, they directly reduce whatever return you do get. The source also mentions exchange-traded funds, ETFs. They're similar in pooling money, but they trade on exchanges just like individual stocks. And then it touches on products like variable life, variable universal life, variable annuities. These mix investments with insurance. The key thing the source points out here is that you, the policy owner, are the one choosing the investments and taking the market risk. Powerful, but you need to know what you're doing.
Which leads perfectly into some really crucial considerations when investing. The source makes this powerful statement, kind of counterintuitive maybe. Time in the market is far more important than timing the market. And it shows S&P 500 data, 1950 to 2010. If you held investments for longer periods, say 20 years, historically, your average annual return was always positive, might have been as low as 2.4%, as high as 14.4%, average 7.2%. But positive. It just shows the benefit of sticking with it, riding out the bumps.
Exactly. And that's where asset allocation fits in. It's about spreading your money across different types of investments to manage risk. You diversify based on your goals, how long you're investing for, and how much risk you're comfortable with. It helps smooth out the ride. Another really smart strategy is dollar cost averaging. This just means investing the same fixed amount of money on a regular schedule, like every month. When the market's down, your fixed amount buys more shares. When it's up, it buys fewer. Over time, this can lower your average cost per share. It takes the guesswork out of trying to time things.
Okay, now this next part it's genuinely eye-opening. A real aha moment for me reading this. How risky is the risk? The book does this math that just messes with your head about average returns. Imagine an investment boasts a 10% average annual return. Sounds okay, right? But maybe year one it went up 70% and year two it dropped 50%. You'd think maybe you broke even or gained a bit. Nope. If you put in $100, after those 2 years, you'd actually have $85. That's a 15% loss.
Yeah, it's wild. And here's another one. What if the average return is 0%? Maybe down 50% one year, then up 50% the next. Average is 0. Seems like you're back where you started. Wrong again. That $100 becomes $75, a 25% actual loss. But the real kicker, the thing you have to remember is this. If you lose 50% of your money, you need 100% gain just to get back to even. That explains so much about why people felt wiped out after big downturns like 2000 or 2008, even when the market eventually eventually recovered. Recovering losses takes huge gains.
It completely reframes how you look at volatility, doesn't it? Draws a sharp line between average return and your actual, in your pocket, actual return. So the big lesson from this has to be, don't be too emotional with your investments. The source mentions a study by Dalbar Inc. It found investors who jumped in and out based on fear or greed averaged only a 4.3% annual return. Meanwhile, just buying and holding the S&P 500 during the same period yielded 8.2%. Your emotions can literally cost you half your potential return.
Moving into retirement plans. The book contrasts defined benefit plans, old school pensions where the payout is guaranteed, with defined contribution plans like 401ks or similar plans. Here, you know what goes in, but the final amount depends on how the investments perform. And it highlights a big problem: the passive employee, someone who doesn't really understand their plan, doesn't know the fees. Those fees can seriously erode the balance over time, potentially cutting the final amount by as much as 30%. That's huge.
A 30% hit just from not paying attention? Ouch, that's avoidable. Okay, in the U.S., we have IRA and Roth IRA as key tools. Traditional IRAs often give you a tax break now, grow tax-deferred, pay tax later. Roth IRAs use after-tax money, grow tax-free, and qualified withdrawals are tax-free. Big difference. Plus, rollover options are important too. In Canada, the main players are the Registered Retirement Savings Plan, the RRSP, and the Tax-Free Savings Account, the TFSA. And there's always that debate, isn't there? Which one is better for you? Depends on your income now versus what you expect in retirement.
And there's planning for education, college university savings plans. The costs are just mind-boggling. The source quotes figures from 2013, $245,000 just to raise a child to 18 in the U.S., then add potentially $130,000 for 4 years of private college, and projected costs 18 years out, over $300,000 for that degree. So dedicated plans like the US 529 Savings Plan or Canada RESP are pretty much essential if you want to help fund that.
Okay, what about later in life? Living too long, outliving your money. The book talks about annuities for this. It describes them kind of like a race bet on how long you'll live. You give an insurance company a lump sum, they bet you won't live long enough to collect it all back, plus more, you bet you will. They have different phases: accumulation, payout, and types. Fixed annuities pay a set rate. Fixed index annuities are interesting. They often have a cap on how much you can gain if the market does well, but crucially, they usually have a floor, often 0%, meaning you don't lose money if the market tanks. That offers real peace of mind for some people.
Right. And finally, the source covers some other solutions needed for a complete plan. In the U.S., there's Medicare, the health insurance for folks over 65. It has different parts: A, B, C, D, plus supplemental plans, Medigap. The book uses a helpful analogy. Original Medicare is like a PPO network, more choice. Medicare Advantage, Part C, is more like an HMO. Managed care helps clarify the structure. And long-term care, LTC, this is increasingly important. Stats say 70% of people over 65 will need some kind of long-term care, and it's expensive. Average costs cited were like $83,580 a year in the U.S., $47,000 in Canada. That can drain savings fast if you haven't planned for it.
Definitely a lot of pieces to fit together for that full picture. And one last piece to really secure things is estate planning. The source makes a great point. Everyone has an estate. It might be huge, or it might just be your house, your car, your savings. Planning with wills or trusts isn't just for the super rich. It's about making sure your assets go where you want them to go. A living trust, for example, can help avoid probate court, which can be costly and slow. It's all about control and ensuring your wishes are followed smoothly. So after all that, what does it boil down to for you, the listener? How do you put this into practice? The book sums it up with a plan of action called Saving Your Future. It's about facing the challenges but having the guts to change. First, increase your cash flow. Look for ways to earn more, maybe a side hustle, multiple income streams. Second, spend less, save more, be strategic, cut the non-essentials. Commit to paying yourself that 5, 10, 15% first. Third, attack your debt, get rid of it. Interest payments are just wealth killers.
Fourth, you got to invest in yourself. Understand how money really works. Learn to make it work for you. That's key. Fifth, set clear financial goals. Have a real plan. That includes protection, managing debt, building wealth consistently, even starting small like we talked about. And finally, sixth, embrace change. Expect to succeed. This means ditching old bad habits, surrounding yourself with supportive people or environments, and really believing you can win by sticking to the plan step by step.
And as we wrap up this deep dive, here's something to really think about. Some food for thought, building on a point the source makes. You might be feeling the financial squeeze, and that's a real struggle for many. But consider this perspective. Half the world's population, over 3 billion people, live on less than $2.50 a day. About 80% live on less than $10 a day. Then the source contrasts global spending. Billions going to cosmetics, perfume, cigarettes in wealthier nations, compared to the relatively small additional amounts needed to provide basic needs globally. $6 billion for basic education for all, $9 billion for water and sanitation, $12 billion for reproductive health, $13 billion for basic health and nutrition, just a fraction of what's spent elsewhere.
It really puts your own financial journey into a bigger context, doesn't it? It kind of encourages you maybe to not only use this knowledge to secure your own future, which is vital, but also to think about how your financial success, once achieved, could potentially enable you to help others who are facing far greater challenges. It suggests that financial literacy can have, maybe even should have, a purpose beyond just yourself, something to really mull over.